Corporate finance practice problem using OneNote. We're going to have a future value of 1 and present value of annuity calculations as we analyze a practice problem related to a loan which has uneven loan repayments. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote and would like to follow along, you're not required to, but if you would like to, we're in the tab on the left-hand side. We're in the practice problems down in the 952 FV future value of 1 and present value annuity loan uneven repayments. Also note that when using OneNote, you might want to take a look at the immersive reader. Many of our presentations are also mirrored down here in the text items, which basically have transcripts to them. Transcripts which can be translated into multiple different languages in either read or listened to in multiple different languages, thereby being a good complement to the presentations up top. Closing the tab back up, we have our information up top. We're going to be calculating that information in the blue areas down below, like with prior problems for present and future value. We will do many of the calculations in multiple different ways as we move through the practice problem. So we have a loan type of situation, and we're going to have a repayment on a loan. Note that oftentimes when people think of a loan, they think of a loan that has a standard fixed set of payments that are going to be repaid, such as a mortgage paid monthly, same amount paid monthly, or a car payment or any kind of payment. Typically, they set the payment amount to be the same, and then the difference will be changed in terms of the interest and principal on the payment that is being made. But when you have a business loan, you could set up the loan in any kind of different way. We might have different structures, especially with a business loan. For example, we might pay the whole thing back in the future or just pay the interest on it for some period of time. So we're going to have a bit more unusual of a loan situation and try to analyze that loan situation. So the loan's going to be for $55,000. We're going to say the years before any payment are 8 years, and that's going to be at a rate of 10%. So we got the $55,000. We don't have to do anything for the 8 years, paying back either interest or principal on it, and we're going to use that hopefully to generate money and not just to have a good time during the 8-year time period, because we do have to pay it back in the future. And then in the future, after that point in time, we're going to be paying it back in 16 equal payments. And once we need to pay it back, it's going to be at a rate of 14%. So then the question is going to be, okay, well, when we pay this thing back, if we have to pay it back in 16 equal payments and the rate is 14%, what will be the payment then that we'll have to be making for those 16 payments at that point in time? So to figure this kind of problem out, we would first need to say, okay, here's the $55,000 loan we're getting now. Where will we be at the end of this kind of free period where we're not paying back any interest or principal, so that we can get the future value as of the end of this time period? Once we have that value, then we can then think about what the payment needs to be in order to have 16 payments that will then pay off the loan at that point. So it's a two-step type of process. First, we're going to look at the future value of the loan after kind of the free period, the free component. So to do that, we're going to use our future value equation. You can also use Excel and whatnot. We'll take a look at this in multiple different ways. First, with the equation, future value equals the present value times 1 plus r to the n. The present value being then the 55,000, 1 plus r being the 10% to the number of years. In this case, years, the periods being 8 in this case. Let's break that out into a table type of format where we have the present value in the outer column here. And then we're going to pull into the inner column the 1 plus the rate to the n. So there's going to be the 1 plus the rate at 10% adds up to 110% to the number of periods, or 8. And that's going to give us our number down here. Let's run that through our calculator real quick just to practice the fact that we do need a calculator that will then have to the power of. In Microsoft, we could then hit the drop down if you're using your computer here. Scientific calculator is what we're going to take a look at. We have the 1 plus the 0.1 gives us 1.1 or 110%. In other words, we're going to take that to the power of by using the x to the y item here. Is that what we use? Yeah, x to the y item. That puts the caret up top. And then we're going to have 8 periods to the 8. And then we're going to say, okay, and that gives us about the 2.1435888. And then we can do the last part, which is this times that. And so if we pull out the trusty calculator just to do that, we're going to say this times the 55,000. That's going to give us our 117,897.38. Going to go back to my normal calculator, hitting the little, what do they call that, a hamburger, the hamburger, and then minimizing this thing. So that's going to be where we're at. So at this free time period, the 55,000, hopefully we're using that to generate revenue, because we are going to end up paying interest at some time, or we're having a good time in the short run, and then we'll think about what we're going to. So then that means that after that 8 years, we got the 117,897.38. Then we got to think about, now we have to pay that back in 16 payments, and the interest rate is now the 14%. That's the second half of the problem. Before we get to the second half of the problem, however, we'll calculate the first half a couple different ways. If you want to jump to the second half, then you can do so. Feel free to do so. We'll calculate this a couple different ways now. We'll do the running balance type of calculation for it. This often giving us a better understanding of the actual calculation. Difficult to do by hand, easy to do with Excel. So we'd start off with 55,000, of course. We would take then the 55,000 and we'd multiply it times the rate, which is going to be the 10% times the 10%, 0.1. That's going to give us the 5,500 plus the 55,000. We're now at the 60,500. If we multiply that times the rate of 0.1, we get the 6050, the 6050 being the interest plus the prior balance of the 60500. And we see our debt increasing here. It's scary to watch. We're trying not to watch it. We're just having a good time. But if we were to look at it, we're like, whoa. And then if we take that and say times the 0.1, we get the 6655, and we're going to say plus the 66550, and that's now at the 73,207, and so on and so forth. If we continue that process down, gets us down to the 117,897.38. So let's do it a different way. Let's do it with an Excel type of calculation. If you're doing this in Excel, this would be the most common way, most likely in practice this way, or a financial calculator. I think Excel's probably more used than maybe in a financial calculator these days, possibly. You can do Excel on your phone, I think. So anyways, it'd be the future value of the rate, which would be the 10% up top, and then the number of periods. That's going to be 8 in our case, because they are going to be yearly. And then we're going to say that it will be comma, comma, and the present value of 1, because it's not an annuity, once again getting us to that 117,897.38 again. We can also do it one more time with the tables. Last time, ending it off with the table time before we get to the second half of the problem. We're looking at the periods of 8 periods and rate 10, 10 and 8, 10 and 8. Make sure you got the right table down here. This is not an annuity. This is just the future value 1. So we got the 10, we got the 8, we got the 10, we got the 8, we got the 2.1436. So there it is, 2.1436, 55,000 times the 2.1436 gives us the 117,898, similar but not exact to the 117,897.38 due to the fact that the tables are rounded to the 4 digits. Okay, let's get to the second half of the problem now. Second half of the problem, we now have the amount, the ending amount that we came to was this 117,897.38, and we're told that we need to then pay that off in 16 payments. We're assuming equal payments, and the rate now is not 10%, but 14%. So now we got to say, okay, now we got to pay it off. There's a couple ways we could do it. We can use the mathematical formula. We'll take a look at that. We can use an Excel function down here, and we can kind of back into it with the Excel function for the present value of an annuity, or we can use a payment function, which we'll take a look at as well. This isn't really our main focus because we're kind of focused on the present value calculations, but this is an alternative, function related to the present value calculations, probably the most direct way to get there. But we'll start off up top with our formula. So you can do this algebraically. Notice that we're not looking for the ending number here because this isn't going to be the present value. I know what the present value is. The present value needs to be this 117,897.38. So it would be that number equals P, the unknown, we're solving for P, times 1 minus 1 plus R now 14%, to the negative N now 16 periods, divided by R, once again, 14%. So once we have that, we have the one unknown. We then solve for that one unknown using our algebra. I won't do it algebraically, but I will put the equation down here in our table type of format. I'm not going to readjust the table for an algebraic equation, but just put it in there like we normally would and consider how we could use trial and error in Excel, like a goal seek, to do the similar kind of process that we would do algebraically to find the unknown. That concept then we will use down here to think about it in terms of an Excel function, and then we'll look at the more precise or exact Excel function that's designed for the payment calculation. So let's go back up top. We're going to say, let's plug this into our table. The unknown would be this 18,818. Now that's the answer, but if I didn't know what the answer was, I could plug this into the table, and you can imagine just putting 1,000 up in the table here, and then we'll complete our equation. We got the numerator 1 minus 1 plus r. I'm going to put the 1 in its own column, and then continue with the numerator 1 plus r to the negative n. 1 plus r, 14% now. That's 114%, 1 plus 14%. Then we got to take that to the number of periods, negative number of periods, that being 16, that to the power of negative 16. So 114 to the power of negative 16 gives us about 0.122892. We take then the 1 here minus this number we got to. That gives us the 0.877108. And then that's the whole numerator divided by the denominator, which would be the 14%, giving us then this 6.2650596. We take that then and multiply out the outer columns. If we had something other than the answer up top, like 1,000, we would get to an end result that would be different than what we know it should be. We know it should be this number. And then you can imagine, of course, using a trial and error method to basically increase the payment until you get to the point where the end result is what you expect it to be in a trial and error type of method, which would be quite tedious if done with the trusty calculator over here. Not difficult, however, if done with a spreadsheet. So you can imagine using a function such as goalSeek to basically figure that out. You could say, hey, Excel, would you set this cell to be what I know it should be, because I know what the end result should be. I need it to be this, by changing this cell up top, and then it'll basically back into the unknown without reworking the algebraic problem. Now that concept is useful because we can apply that concept down here to our functions. So note there is a function down here, and I haven't been mentioning this the whole, you could have a payment function. If you could find another function, if you have a particular function and you say, hey, I know this function works, I know what the unknown is, meaning I know this amount, I know the rate, the number of periods, I don't know the payment. You have two options. You could say, okay, I know this function, I'll use this function, even though the end result isn't the answer, or I'm going to look for another function that will do the same thing. In other words, I can't rework the function algebraically. I can't use algebra to rework the function, but I can use goalSeek to kind of use it algebraically, or I can ask Excel to find it being reworked algebraically, right? I could say, is there another function for the payment, which there is in this case, and go look for that. So those are kind of your options. But like with our equation up top, when you have your equation, it takes more mental energy to memorize another equation solving for P. So you might use the same equation. You can apply that same concept with goalSeek down here. And if you know one function and you know one unknown, there are circumstances where you might just say, I'll just use goalSeek to figure that out. Or you can, again, look for another function that does precisely what you want, which Excel has a ton of functions that might be able to find that, but just keep those options in mind. So in any case, if we used this function, this is the one we're kind of concentrating on, the present value of an annuity, we would say this is the unknown is the end result is what we want. That's going to be the end result. The unknown is part of the function here. So we'd say the end result is here, and I'm going to put some amount, like the $1,000, in another cell, for example, or possibly this cell, in order to basically figure it out. Actually, I put it in this cell in order to figure it out, and then change that using goalSeek. So in other words, present value, rate we know, 14%, comma, number of periods we know, 16, comma, the payment we don't know, we put into this external cell. If we started out with $1,000 or something like that, then when we enter the formula, it would give us a result that would not equal what we know the end result should be, which should be this. And then we can use goalSeek in the similar fashion, changing this cell, telling Excel, please change this cell until the end result gets to what we know it should be. And then Excel can do that in a similar way as we saw with the function concept up top. You can also look again at Excel and say, hey, is there a payment function here? And then find that payment function, and then Excel basically reworks it, has another function to do the payment. Payment function looks like this. This isn't our primary focus, but obviously it's a useful function, and it's related. So it'd be the payment, it's going to be the rate, once again picking up the rate, which is going to be the 14%, comma, number of periods, which is going to be the 16, and then comma, the present value then is that 117,897.38, and this would be the more direct way to get right to our payment option using the function of the 18818.24. So those are a couple ways to get there from here. And then of course we can use the table, which you might see in a book type of problem. We're trying to back into the amount then. So usually we have the amount and then we look at the table to get to the future value. Now we don't know the amount. We could still find the amount on the table and we know the end result. So the amount on the table would be 14%, 16 periods, 14 and 16, which would be right there, 6.2651. So 6.2651, and then we can say, okay, if I know the end result, 117,897.38 divided by the amount from the table, 6.2651, we get the 18,818.12, about close to, not exact, to the 18,818.24 due to rounding, tables rounded to 4 digits.